Welcome back to the Closing Room AZ. I'm your host, Jesse Moreno, realtor and investor, and your straight shooter for everything real estate and here in Phoenix, Arizona. If you're thinking about selling, buying a home, or just trying to figure out what's going on in this crazy market, you're in the right spot. You're in the right podcast room. Here it's all about straight talk, no fluff, no fillers, just real strategies, how to get you into a property. And obviously it's just real talk all the time here in my podcast channel. If you find this helpful, please make sure that you like, subscribe. There's that QR code I need you to click on, take a picture of, grab my information. It's the best way to reach out to me and send me a text or message, whatever the case may be. So follow me on my channel. And again, hit that QR code there and get my info. A quick shout out to my sponsor once again. We have Drake's Title. They've been in business for a while, since 2007. They've closed over 200,000 transactions and still going strong. If you're looking for some reliable service from contract to close, you got to reach out to Drake's Title. Give them a call directly. You can reach them at 602-796-2029. Ask for Ignacio Ochoa. He's the business development manager here at Driggs, and he'll help you with your next transaction. And when you do give him a call, let him know that you heard about him here at the Closing Room AZ. So let's give him a little bit of love. All right. So welcome back to our part 2 of our Mortgage 101 series here at the Closing Room AZ. So if you caught part 1, you already got a solid foundation, what mortgage is, the loan types, how pre-approval works. Today we're going to go a little deeper. We're going to talk about something that every other that buyers obsess over, but very few actually understand. And I'm telling you, you got to stick around for this one even to the end, because we're going to give you some more information that you don't want to miss. We're going to talk about interest rates and what's going on in this market. We're going to talk about the closing cost of home ownerships, that don't show up on the listings, on the listing price. So we're going to talk about these things. And Ben Salcido from Barrett Financial Group is going to be back with us right now, and he's going to guide us through this. And we're going to ask him a lot of questions because we're going to go ahead and pick his brain because he's the expert here. And as always, I'm excited to have you here on my show, you guys. So Ben, welcome back to the show.
Appreciate it. Thank you. Happy to be back, Jesse. Let's dive into it, man.
Yeah, for sure. I got some questions written out for you. I wanted to make sure we address them because I think it's important, obviously, as always, that our listeners know exactly everything about Mortgage 101. I'm going to tell you right now, I'm going to lay it out there. If you're on the show and you're listening to this, man, you're going to know more than 90% of the people that are looking into either buying or refinancing. Man, you're going to know more than 90% of these people because we're going to get a lot of knowledge here on this particular show today. So let's dive into my first question. I think it's one that my buyers like to know is, how do interest rates work and what actually determines the rate buyers get?
So there are 2 layers here. I mean, the first is a macro level.
Sure.
The broader interest rate environment, which is influenced by things like Federal Reserve, inflation data, and bond market. Okay. The 10-year Treasury yield in particular is closely tied to mortgage rates as well. So when inflation runs hot, then rates go up.
For sure.
Right?
And that's true. Absolutely.
Yes, and then when the economy cools down, rates typically come down as well. So
Right.
it's kind of like obviously an effect there, right? Cause
Right.
an effect there. There are levels, obviously, to individual rates and what you specifically can qualify for. I mean, the massive impact to that is going to be the credit score. You know, anyone 720 and above is going to have significantly less cost on the rate as
Sure.
somebody with maybe a 620.
Right. The higher the credit score, the better.
Correct.
Right.
Yes, sir.
But I know in this particular environment that we could go as low as, and I could be wrong, you correct me, but I think maybe 580.
Yes, sir. Yeah.
Right.
I mean, I've closed a loan at 520. So
520.
yes, sir.
I didn't even know it was out there.
Yeah.
Let me guess, man. 520 FHA.
520 FHA, but they did have compensating factors as well. So, I mean, they did have reserves and things of that sort. I mean, I do have non-QM stuff. I believe that one was non-QM though.
Right.
Yeah.
No, for sure. Hey, let me add a little bit to what affects what determines rates as well, right? Because I mean that was great info that you just shared with us. I think it's important people realize that it's not just the lender's going to place the rate out there and say, hey, today's rates are going to be 6 point whatever %, right? They're just going to throw it out there. There's all these compensating factors, you guys. And I just kind of want to add something to it because when you said, it's based on the 10-year treasury yield, right? Or it could be based on the 6-month bond, or it could be based on the economy, the inflation, right now where the economy is going, and right now with, what's happening in the Middle East and so forth.
Yeah.
Rates fluctuate. Things happen, right? People are watching and trying to see what's going to go down, and so these are all compensating factors. And then you got the biggest ones as well that kick in, and you mentioned the credit score, the individual level, right? Interest rates is going to be based on your credit score, and so the higher your credit score, the better your rate. The lower the credit score, a little bit more aggressive interest rate that you're going to receive, but it doesn't mean it's not doable. And I'll tell you, I maybe I'm speaking out of term here. I could be wrong. You correct me, but I would say that doesn't matter what your interest rate may be. There's a program out there for you.
I agree. And again, I mean, when it comes down to, again, I think we spoke on this the last time when you're renting, right? I mean,
Right.
you're paying 100% interest. I mean, it just is what it is. You're not making an investment into yourself. So I think any rate that you're getting to get your foot in the door, rates change on a consistent basis. Give it 6 months, give it a year. There's a possibility for refinance as well. I mean, it just really depends on your situation. But I would say never let rates stop you from purchasing.
For sure. Right. Absolutely. All right. What is the difference between a fixed rate and an adjustable rate mortgage, right? I mean, which one makes better sense at this moment based on our market? What would you say?
Well, I would say it really depends on the buyer, right? I mean, a fixed rate's always going to be most beneficial if you're going to be there and you're set to be there for an extended period of time, you know?
I'm going to keep this house. It's my retirement home. That's when you say,
yes,
get
sir.
the fixed rate.
Yep, we get the fixed rate. We get the fixed rate. And again, I mean, that could always be adjusted regardless one way or another. I say adjustable rates are obviously going to be adjustable. You have a set term for a set time of that rate, whether that be 5 years, what have you. Typically, I will do an adjustable rate if it's going to be something where someone plans to be moving within a certain period of time, 3 to 5 years. And hey, listen, why not get the lower rate for the amount of time that you're here, right? Then we'll go ahead and sell your home at whatever time we need to sell your home and move on.
Yeah, for sure. All right. Good point, man. I like that. That's a good point. Let me ask you about the rate buy down, right? Because then people ask, hey, I want to get the better rate. Can you lower my interest rate? And there's a way of doing it. It's called a rate buy down, correct?
Correct. Yes.
All right. So when should a buyer consider doing a rate buy down?
Well, I feel like when the circumstances are correct, right? Say that we're getting any type of seller concessions. I think that, if they're going to be giving up money for you to close on your home, it's always beneficial to take a look at the rate buy down. If you come in with a certain amount of money that you have saved for closing costs and things of that sort, we're able to negotiate. I mean, you yourself being a real estate agent know that 3%, 6% concessions have happened in the past. Right now, I think we're currently seeing 2.5% to 3% concessions when someone is selling a home. We take a look at a rate buy down.
Yeah.
Right. And I mean, if let's just say par is at 6.875 and we can get you to a 6.5 and it makes sense to do so with what that rate cost and we have the flexibility and the concessions to do so, why not?
Right. Right. And I know sometimes the rate buy downs could be a little bit on the higher end as well. So it's something that you can educate them, say, look, to get this rate down to this price, it costs X amount. And you mentioned sellers concessions to be applied towards the buy down of the rate, right?
Correct. Yep. Closing cost. Yep.
Yeah. What about from the lender side? Is there things where you guys are like, hey, there's a lender credit?
But yeah, we do also have lender credits from time to time. I mean, really depending on what type of program we're looking at. Again, I mean, there's all types of different ways to get lower rates. It just really depends on the circumstance of the buyer.
Sure. All right.
I like to say that we're not a one shoe fits all. Anytime that a lender tells you that that I did this for this person and you're going to be exactly the same, I mean, I just would definitely get a second opinion.
Yeah,
on that.
and that's not true for sure. You're right. Absolutely not, man. It's always different for everybody. Everyone has a different circumstance.
Yes, sir.
So it always goes back to making sure you reach out to your lender, reach out to Ben, so you know those things, right? You just can't wing it and figure out and think, well, if John down the street got that rate, it's going to be the same for me. It won't be. It might be something different. Or maybe, I don't know, maybe you got the same credit score and all the other
same debt to income,
right?
Same credit score, same house, same.
Right? Yeah, it could be. Who knows? All right, man. Well, thank you so much about sharing the rate buy downs. And I know we're going high level here, you guys. We're not going to break it down too deep into details, that could be a longer show, and we could spend a lot of time in that. So Mortgage 101 is really just giving you some high level, so you guys have it. The big thing here is for you to reach out to him, reach out to me. Let us give you more detail, more information regarding Mortgage 101. That's the key of this conversation. That's the key of this podcast, is to educate you enough to have you have a good understanding. But if you really want to be that expert, have a lot more, you got to reach out to the specialist here. In this case, reach out to Ben, who's our senior mortgage agent, loan officer with Barrett Financial Group. So, all right, so let's talk about closing costs now. All right, let's talk about what buyers miss during the closing cost part of our transaction. Right, they save up for the down payment, and then they get to the closing table, and then there's another stack of money that they weren't expecting that's part of the closing costs. Right, they're like, hey, all you told me was 3.5%, but there's more to it than just 3.5% down payment, as an example. Correct?
Yes, sir. So closing costs are going to be all fees and expenses associated with finalizing your mortgage and transferring ownership of the property. That's typically runs between 2% to 5%, I want to say, of the loan amount. So let's just say on a $350,000 purchase, it could be anywhere from $7,000 to $17,000 on top of your down payment. And that's why we talked those seller concessions earlier as well, because we want to be able to help out with things of that sort. Closing costs can get a bit pricey, so it's not necessarily just your down payment that you're coming in with. It's other costs as well that obviously tie into purchasing a home. There's lender fees, origination fees, underwriting fees, processing fees, third-party fees, appraisal that's paid even prior to closing, title insurance, settlement fees.
Hey, stop telling us all that. You're scaring off the listener here.
Yeah,
they're like, that's a lot of fees. I don't want to do this no more.
Yeah, there can be a ton of fees, but
no, for sure.
Really depending on, again, who you're working with. I mean, someone like yourself, Jesse, that's been in the business for quite some time, are going to be able to negotiate a lot of those concessions and things of that sort, and be able to come in with as little money down as possible. I mean, depending on whether you're doing a DPA or not, you may come in without any money, $500, $1,000, possibly, really depending on the concessions and, if you're getting down payment assistance or not. So, I mean, don't let that scare you. Again, everyone is different. Everyone's going to have different down payment associated with their home. Everyone's going to have a different closing cost associated with their home. It's all about who you work with and how good your team is. Yeah,
good point, man. So recap on that really quick. I think it's, you could always rewind this video and and listen to what he just said. But again, on an average, other than your down payment, as far as closing costs, you can have an additional 2.5% to 5% that you got to be, you got to be aware of and put that into your fees as you look into your transaction. But working with a strong realtor, working with a strong lender, we're going to give you these options and talk about those concessions, because it's true. If you get assistance especially if it's a purchase, you're the buyer. Why not talk to that seller, and let's reach out and let's ask him for some of those seller's credits. And at the same time, even ask the lender. Let's put him on the spot and ask Ben, hey, what's some of the lender credits, man? So we could go ahead and help out with some of this closing costs. It's if you don't ask, you won't receive. So I mean, that's what I always tell my people, my clients. Let's ask. Don't just assume. Let's ask for it. And if you're working with the right party and the right folks, we're gonna do that for you anyways, because that's our goal is to provide you the best service and the best transaction that we can in our deals. So, all right, appreciate that info, man. Good stuff here. So let's talk a little bit about, and I'm gonna throw an acronym, but tell me what it stands for, and let's just talk about this a little bit. So, what is PMI, and how can buyers get rid of it? And you know what? Before you even answer that question, let me share something with everybody else, and that is this. When you put a certain percentage down as a down payment, you're going to have, on a conventional side, you're going to have something called PMI. On an FHA side, you're going to have something called MIP. And so we want to kind of tell you what that means, right? So, but I'm going to let the expert here kind of break it down for you. So what is PMI, and how can buyers get rid of it when it's added to their mortgage?
Excellent question. So PMI is private mortgage insurance. It is required on conventional loans, so I'm glad that you did differentiate that from MIP, which would be mortgage insurance premium. But on a conventional loan, if you're putting 20% down, you can definitely go ahead and get rid of PMI, or private mortgage insurance. It does protect the lender. Obviously, it doesn't protect you in case of default, but it does protect the lender in case of default. It's typically between 0.5% and 1.5% of the loan amount per year added to your modified payment. Is basically.
Gotcha. Okay. Easy enough.
Mhm.
All right. All right. And so what about on an FHA?
So on a FHA, again, this is going to be mortgage insurance premium, right? Works a little bit differently. With less than 10% down, FHA mortgage insurance stays on for life, right? So, I mean, ultimately, it doesn't necessarily fall off as it would with conventional, even if you're paying, say, even if you don't put 20% down. Once you hit that 80% equity with the conventional, it does automatically tend to fall off. But FHA loans are a little bit different. It does typically stay on there for the entirety of the loan.
Is there a way to get it off? Is there an option that on an FHA, if you're like, hey, I want to get rid of this PMI,
Oh yeah, definitely. We can always refinance into a conventional if that's what you'd like to do.
refinance it? There you go.
Yes, sir.
So that's the catch. Refinance it to a conventional deal.
Yes, sir.
All right, cool. And maybe it's not a question I don't know if I was going to ask you this question now, but now that it's come to mind, when it comes to the interest rates between the conventional and FHA, what seems to be a little better right now in the market?
FHA seems to be a little bit better right now, but again, I mean, it really depends because if you have that 80% currently 20% equity that you currently have right now without PMI, it could be better off being conventional, right? Depending on what we're kind of looking at. So,
All right, man, I love that information. I think that's key. So, all right, so if you're going to go conventional financing and you're going to put anything less than 20%, you're going to have PMI, private mortgage insurance. So beware of that. Be cautious. That's going to be an added premium, an added payment to your standard principal and interest payment. But the good thing about it is you could always, like you said, when it's under 80% of the property value or the loan to value LTV, it's under 80%. It typically comes off. Or call your lender. I don't know if it typically comes off. I think you need to call your lender and say, hey, can you recast my deal? And they'll recalculate it, and boom, it'll come off, and you're done. But an FHA, you're gonna keep it until you either A, sell a property, and at that point, whatever it is. But if you plan to continue being with the home, and you know your home is worth now a lot more than where you were when you first started, then you reach out to your lender, and maybe he could refinance you, help you out, and get you out of that, and get you into conventional loan, and get rid of the MIP. At that point, correct?
correct. Yes,
So,
sir.
good way to go. All right, let's dive a little bit into costly mistakes, right? That you see buyers make during the mortgage process. So the deal it's in processing. What are some of the mistakes that we could run into?
Well, I'd say costly mistake. I think number one, only shopping on rate. Um, Buyers will jump on a lender who will quote them an eighth of a percent lower without looking at total fees, closing costs, things of that sort. Lenders typically track record of actual closing on time as well. So, I mean, basically, like, I guess what I'm saying there is, are we going to close on time?
Sure.
Right. So it's important to ensure that you have all this done up front. Typically, what I tell people is if you're going to go ahead and shop me, feel free to do so. But let's do it before we get under contract, right? Because at that point, now we're under strict time to kind of go ahead and get these things done. We want to make sure that everything goes smoothly.
Right.
Um, a low rate with high fees obviously can cost you more than slightly higher rate with lower fees. So always compare APR and loan estimates side by side. Again, I think that's probably your number one.
Right. Just so that the listeners understand, know this, when we talk about the APR, the annual percentage rate, keep in mind, you guys, that is the rate with the cost involved. So it's not your interest rate of, let's just call it 6%. Let's say your APR is 6.5%. You go so your interest rate's 6, your APR is 6.5%. That's because the APR calculates the finance charges in your payment, and that's where the APR. Now it's an annual rate. That's why it's called the annual percentage rate. Don't get alarmed when you see it. It just means that's the cost that's built into it. What you really should be concerned about is more so, if anything, is going to be obviously the rate, right? The locked rate that you have during your transaction. So other big things that might be an issue, maybe, opening new accounts, perhaps buying a car during the process, because when you're in process, when your loan gets submitted to processing, you don't want the following things to happen, or at least you don't want to do the following things. What would those be?
So I would say absolutely correct. Yes, buying a buying a car is probably not a good idea prior to, especially if your car payment's going to go up. You
Now,
know,
why is that, man?
well, obviously that's going to affect our debt to income, right? It's not a beneficial thing when you're purchasing a home, right? Because we want to
Right.
ensure that we're able to qualify for the home that you want, not necessarily the home that you're going to settle for. Although I think that any home that you purchase is going to be beneficial for you, sometimes that'll hinder you from getting the house that you actually want,
Right.
right? Obviously, I think other things like job change, large deposits, things do have to be in accounts and seasoned as well for a
Sure.
certain period of time. So, we can come into factor of like having to find out where this money came from, so on and so forth. If we do make large deposits over $10,000, things like that.
Yeah, for sure. I'll tell you, I'm going to give you a quick, just an example of something that happened with my transactions. One of my deals not long ago is they they qualified at whatever payment was based on their debt to income ratio. And in this case, let's just call this that their back end debt to income ratio was a maximum to qualify was 47%. And they went out there and they ended up buying some appliances and they got them financed or whatever. And they were just at the cusp of what they qualify for based on the debt to income ratio. And when they got these appliances, it kicked their payment or their debt to income ratio a little bit higher above it, and there goes their deal. They don't qualify. Now we're trying to figure out and scrambling the lenders. I'm working with the lenders scrambling trying to figure out what they can do. Now they got to follow their guidelines as well. They just can't make the exception and say, well, no worries, we could just increase it, because what happens is they got to sell your transaction or your deal in the secondary market. And so they got to be within a certain guidelines in order to do that. And not to get too deep into it, not to confuse you guys, but there's a lot of reasoning behind that. But it happened to us, and it happened to me, and I was like, couldn't believe it. I was like, come on. I've been telling you, and I tell you what, I'm sure, Ben, you do the same, is you educate the buyers, and when they start the process, and you're like, don't do the following. Here's a checklist. Don't do, don't open credit cards. Don't go buy a car. Don't get appliances. Don't change jobs. I mean, you lay it out, right?
Oh, 100%. Yeah, definitely lay all that stuff out prior to. I do have clients that are I'm working with currently at the moment are telling me, hey, I want to buy a car. I want to buy a car. When can I buy a car? And I'm telling them, hey, let's get closed and then we can buy our car.
Yeah.
Okay. Let's
Right?
go ahead and get the big things out of the way first, obviously. And then we'll definitely come back and you can buy your car all you want, go get all the furniture you want, max out your credit cards if you want, completely up to you. But obviously until that is signed, that contract is signed, and we have that funding. Let's not move
Don't do it.
anything.
Yeah. That's for sure, dude. Well, there's I tell you a lot of stories, man, but it's just crazy sometimes what people do, even though you tell them don't do these things, they just get excited. I don't know. Maybe they're like, hey, I'm excited. I got this house. Now I got to plug in some things and I got to bring in some furniture or something now because I'm excited. Don't do it until you close, right?
Yeah. I think people do get excited, obviously, by purchasing a home, and especially your first home, very exciting situation. But just make sure that you're constant contact with your lender, have that personal relationship. I think is huge with your lender as well. I talk to most of my buyers on a daily, weekly basis. Just checking in, making sure that everything is going smoothly. They're checking in with me, so I think it's very important to just have that relationship and obviously trust who you're working with,
Yeah,
because I mean that's huge. Just going through that process, you want to have that trust.
absolutely. Absolutely. Last question I got for you, man. So what do you wish every buyer knew before they even started the process?
Man, I would say
Before they get pre-qualified, before they start anything with you, what do you wish they knew?
that talking to your lender before you talk to your real estate agent, I think is super important. I think
Yes.
a lot of individuals, they will come to a real estate agent and be like, hey, I'm ready to buy a home,
Mm-hmm.
blah, 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 so on and so forth. And what they don't realize is that obviously prior to that, you need to speak with your lender, because most real estate agents are going to direct you to your lender first
Sure. Absolutely.
to even see if you're even qualified to purchase a home. And after that's done, they will obviously take some time to kind of take you out there. I think the biggest frustration between real estate agents and buyers is just that, you're coming to me, but you're not even prepared to purchase just quite yet. So I think that's one of the biggest things. I think another smart thing you can do is know your budget.
Absolutely.
I think that's huge. Just considering what's going on right now in the market, I know a lot of people, even when you're renting, are taking into consideration 3 times the rent. Right, you have to make more than 3 times the rent. So I think obviously knowing your budget's going to be beneficial. The way that you approach, just I don't know, anything.
Sure, I got you.
It's preparation.
Yeah, and
So.
absolutely, man. And I'm with you 100% on that because I'll tell you what, I don't show properties, and this is I'm telling you, I don't show properties to anybody until they get pre-approved because I need to know that what you qualify for. I hate to go show you something that you don't qualify for. You get super excited about it, and now it's a disappointment. What a bad experience. What a bad relationship. Bad way to start a relationship with your clients when that happens. So obviously, getting pre-approved is the first step. So I'm with you. I'm with you on that. All right, we're gonna just do a quick recap on this because we want to end this podcast, and then we're gonna jump into serious podcast 3 part in the next episode here. But Ben, man, thanks for sharing that information with us. You talked about how rates work, closing costs, what it actually looks like, and you got a little depth in there. You gave us some numbers. I loved it. You talked about what PMI is and how to get rid of it. That is key. I mean, obviously, it's important to get rid of that PMI. Why have that extra payment on top of your mortgage payment, right? You talked about those expensive mistakes buyers make when comparing mortgage offers, right? This kind of stuff is what, again, in my opinion, is what could kill a deal if they don't do it correctly or if they're not following some proper guidance and direction. And working with the right lender is going to provide you that service, is going to take care of that. So you got to make sure that you are working with the right people. In this case, Ben, you're the man for this one. So I want to make sure that people reach out to you. In part 3, which will be our final series, we're going to talk about what happens when you're pre-approved, the appraisal process, what can slow you down or what could kill the deal, how to set yourself for success, and the best way to get your deal to the closing table. That's going to be on our next podcast show, so make sure you guys stick around. It's going to be a big one. It's going to be a nice big close. So make sure you guys do that. As always, as we wrap up, please make sure that you click on that QR code, grab my information. Best way to reach out to me and get with me directly. If you like this channel, subscribe, leave some comments, provide some feedback, whatever you want, man. I would love to hear from you. So you can always follow me on Instagram or on the YouTube channel. The Closing Room AZ is the best way to get to my info. And again, it's on my QR code, you guys. So, hey, click on that bad boy and get my information. Ben, if we need to reach out to you, man, what is our best way to get to you?
Oh man, you could definitely hit me on the Barrett website. That's for sure. I have my Barrett website, Barrett Financial Group. Social media is always huge. I'm always on social media. So Living Ben's Life. Again, that's Living Ben's Life with a Z. On Instagram, phone number 602-695-5187. But yeah, those are my main points of contact there. Email, all of it.
All right, cool. I'm going to plug in your information on all three podcast shows that we have. So make sure you send that over to me as well, and I'll plug that in there. Obviously, you guys have his information, so you can always rewind this podcast, this video, and get the information in case you missed it. But we'll get that information out to you guys. And all right, well, hey, thank you guys for hanging out with us today. This is the Closing Room AZ. I'm Jesse Moreno. I'm your host, and again, thank you for hanging out with us. This is where we have real conversations, where we drive real results. Till next week, you guys have a blessed week, and remember, set no limits.